We believe that the old 60-40 model just won't be able to cut it anymore.
Chances of 60-40 repeating are virtually nil in our minds over the next 5 to 10 years.
60-40 is dead.
Especially when interest rates are so low. That right now, you're getting a higher interest rate on the SPDR than you are in a bond.
The traditional 60-40 stock bond portfolio isn't going to cut it.
Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. And I thought I'd come to you today with a brief commentary on an article that appeared in Bloomberg a couple weeks back about the death, and I use that term in quotation marks, of the 60-40 portfolio. Now, we don't get too sensational when we do things in the financial press. It's hard to get people too fired up about things, but if you're going to use the term death, that's a pretty good indication that you're about to get a little sensationalized. And in this case, the author went through and basically made the point that this sort of 60-40 portfolio, otherwise known as 60% stocks and 40% bonds, has had sort of a 10% annualized return going back all the way to 1929. But now with treasury rates as low as they are, with the 10-year below 1% and the 30-year treasury bond at 1.2%, that maybe it was time to rethink that model and that you couldn't count on that 60-40 portfolio to give you a 10% return going forward. And interestingly enough, it caused a lot of press. Like the Wall Street Journal picked it up. I got several inbounds from our advisors talking about it. I even got an inbound from a client asking about this article that they had seen or heard about on CNBC. It got a lot of traction, and I felt like it was worth a little bit of a rebuttal or a little bit of a response. And so I'm going to go through a couple of points to just try and illustrate why I think that this is, that the rumors of the death of the 60-40 portfolio have been greatly exaggerated. The first is that interest rates have been low for a while now, right? So this is not new news, right? The 30-year treasury is at 1.2% below today, but we've been below 4% on a 30-year treasury bond for the past decade, right? I mean, in fact, those rates have really been below 3% for the past 5 years. So it's not really new news to say that, hey, there isn't that much yield in fixed income land. The second thing that I would say is that returns on the 60-40 portfolio, as you'd expect in that lower interest rate environment, haven't been close to that 10% number in quite some time. So if you go back, I just ran the numbers going back to July of 2008 so that we would actually pick up a cycle during that time frame, a long drawdown cycle. But if you go back to July of 2008 and run it through towards today, the annualized return on a 60-40 portfolio would have only been about 8%. And in fact, it's the only time that you would really see it at about 10% is if you run it back only about a decade, which is interesting because that's running it back 10 years over one of the strongest bull markets in history, absent this minor blip that we've seen in the second quarter of this year, which we've already sort of recovered from. So it's really a little bit, it's a little bit disingenuous to say that financial planners shouldn't count on a 10% return out of a 60-40 portfolio, because most financial planners have known that those 60-40 portfolios weren't going to return close to 10% for a while now. In fact, most financial planning software would actually tell you that the expectations for a 60-40 portfolio are closer to 7%. Ours, the one that we use here internally, uses actually 7.2% as the annualized expected return on a 60-40 portfolio. So saying that you need to reevaluate your financial planning based on a change in the treasury rates in the past 3 months, 4 months, 6 months, is a little bit disingenuous because the software program's already picked it up and it's already incorporated into your financial plan. And if you think about the return on a 7% portfolio, you kind of get there by saying I've got 60% of my portfolio in equities, which are going to return about 10% a year. That gets me to a 6% return for the overall portfolio. And then I've got the remainder of my portfolio in bonds. The current dividend yield on the Barclays Ag is plus or minus 2%. At 40% of that portfolio, that winds up at about a 0.8% return for the total portfolio, which gets you right around that 7% number that most financial advisors and financial planners would tell you is an appropriate return metric for that 60-40. So once again, not really a reason to panic. The other reason why there's not really a reason to panic here is because low long-term interest rates are fundamentally a huge positive for equity prices. Right? If we think about the way that we value equities, whether it's an enterprise value to EBITDA ratio, or whether it's a price to earnings ratio, or any one of the other ratios that we use to value an equity security, at its heart, it's a discounted cash flow analysis, which basically means that you take the future cash flow streams that you expect from owning that equity, and you discount them back at some appropriate discount rate that's normally tied to long-term interest rates. And the key here is that the lower the interest rates are that you use to discount those cash flows, the higher the price, the higher the value of that cash flow stream. I'm not the only person that says this. Warren Buffett is famously on record back in 2019, back in May of 2019 actually, for saying in a CNBC interview that stocks look ridiculously inexpensive.
I think stocks are ridiculously cheap compared, if you believe that you're going to have the 3% interest. 30-year bonds makes sense.
We happen to agree with him. It's a math problem. And so if you really believe that we're going to see low interest rates for a very, very long period of time, then that's fundamentally great news for the 60% of your portfolio that's held in equities, because the valuation multiples on that should start to increase as those low interest rates hang around. The last thing that I'm going to say about the quote-unquote death of the 60-40 portfolio, and the thing that I guess really kind of got me a little bit angry about the article is that it suggested that retirees should really be taking more risk to generate the returns out of the portfolio that they'd like to see. And so they suggested whether or not that 40% of the portfolio should move into higher yielding, high yield bonds, junk bonds, if you will. Whether or not that 40% of the portfolio should maybe be more like 20% of the portfolio, and they should move a higher percentage into equities. And the thing about that is that the 40% of your portfolio in a 60-40 is there as ballast. It is designed to be the safe assets for when times get choppy. And the current the most recent market example that we have that happened here in the first quarter and the second quarter of a market downturn that was then immediately followed by a meteoric rise on the other side, such that the S&P 500 is actually in positive territory year to date, is not the way that most bear markets play out. Most bear markets take 2 years to develop before you go peak to trough. And as one of my favorite advisors likes to say, our clients like to eat every day. Right? They need to take distributions out of their portfolios on a regular basis to pay the mortgage and to pay the grocery bills and to do everything, keep the lights on. And by making your portfolio incrementally that much more risky, you increase the risk and you increase the downside potential of what happens to the value of your portfolio when you have to make those withdrawals during a steep drawdown, during a long, prolonged sell-off period in the marketplace. And so I really just encourage people, if you're nervous about what your financial portfolio looks like, you can always talk to your financial advisor, you can always talk to your financial planner and lay out what that looks like over time, but just trust that most of the return characteristics and assumptions that are built into your financial plan don't incorporate sort of fantastical results like being able to generate a sustained 10% return out of a 60-40 portfolio. So with that, as always, if you ever have any questions, please feel free to reach out to me or to your financial advisor, and I look forward to talking to you again soon.